You might have okay boomered your grandparents when they started talking about dividend investing, but
it's also a great way to grow your retirement portfolio now through compounding, and a great way to generate income while you're in retirement, lying in blue chairs or flip-flopping around P-Town.
Today, we host Joseph Hogue of the Let's Talk Money YouTube channel about dividend investing.
Joseph is an OG when it comes to investing and the personal finance world. After serving in the Marine Corps, Joseph started his career investing in real estate before becoming an investment analyst for some of the biggest firms out there today.
He's also appeared on Bloomberg and CNBC as an investment expert and has published 10 books in personal finance. This is Queer Money, episode 396. Let's get on with the show. The mission of Queer Money is to financially empower the LGBTQ plus community. Join us in thanking Capital One for supporting that mission. Well, welcome to the show, Joseph Hogue. We appreciate you being with us.
John, David, it's great talking to you again. Thank you for having me.
Definitely. So, folks, you know that we do this series on investing on a regular basis. And John and I have been a little bit more active on Twitter recently. And one of the things that we're seeing a lot of people talk about is dividend investing, whether they're using that as a way of building a retirement portfolio or individuals are using that as a way for passive income. And actually, Joseph, maybe you could answer this question too. But a lot of people are now looking at dividends as a way to build up an income stream, whether it's for their everyday expenses or for retirement. So we wanted to talk about this subject because it's actually something John and I haven't done and are a little bit more interested in doing now because we hear other people talking about it. So Joseph, we brought you on as an expert in investing and we appreciate it. So let's start off the discussion with what are dividends? Really, what is a dividend and how do they work?
Something my grandfather talks about.
Yeah.
Sure. Well, dividends are just a return of profits to investors, right? When you invest in a stock or invest in a company, you own a share of the future earnings, right? And when those earnings come along, then the company's management can say, hey, we can either keep these earnings and invest in future growth of the company, or we can reward those investors with a share of those earnings and return some of that cash to investors. And that's what dividends are. They're just a return of some of your investment or a return on your investment from those earnings paid out in cash.
Yeah, exactly. For folks, this is actually something that the companies of all sizes do, right? I mean, it's not just large corporations that are paying out dividends. John and I are a two-man team in our business, and some of the money that we make actually is passed through to us as a dividend from our company. So companies of all sizes can do this, right? So, what are some of the benefits then of a dividend?
Sure. Well, one of the benefits we're seeing right now is that dividend is always a positive return, right? Even when the stock prices fall, as they've had been over the past year, then you're always receiving that positive cash return from dividends. So it is a positive return. It is an immediate cash return. On a lot of stocks that don't pay dividends, you have to wait until you sell that stock to get any kind of a return. So it's nice to, and it's motivating to be able to collect that cash while you invest in a stock. A lot of investors love that motivation to see when those dividends hit their account, and it really keeps them saving and investing more. It's also a kind of a spending discipline on management, right? We talked about how management has that decision to return some of the cash to investors as a dividend or keep some of for growth. So they are, boards of directors and management knows that once they start a dividend, investors are going to count on that dividend, are going to rely on it. So cutting a dividend is, something similar to putting your mom to work in the coal mines, right? It is a sacrilege. So they take that seriously, and they know that, okay, if we're paying out this dividend and it's got to at least stay the same payment every year or even increase, then we can't spend quite as much on those vanity projects that management loves to spend on. So it is some cash discipline for management. It's also just an opportunity to compound your returns, right? For those of us that aren't living off of our portfolios or our dividends yet, we can reinvest those dividends, earn money on our money, and it's a great way to build your portfolio.
I remember working the phones at Charles Schwab when I first started there, and I remember there would be some people who would call like almost religiously every day, every quarter. What are my dividends? Did my dividends pay out? Why didn't my dividends hit my account? Usually they were retirees. I don't want to categorize a whole bunch of people, but they're always older people. They're just mad that their dividends weren't what they thought or didn't arrive on time.
Right. Well, they were waiting for them to hit their account, because the reality is that there are some people who have an investing strategy that literally is the dividend payment is their paycheck. Right.
Sure.
It is the way that they get paid and they live their monthly expenses on. So you mentioned this idea of the dividend being paid annually or it being paid out by the board of directors. Is there some sort of like required structure around dividends? How do they get paid out?
Sure. Well, there's not necessarily a requirement or a required structure. Most of them pay out 4 times a year, so every 3 months. The board of directors, which is kind of the management of the company, right? They will get together and they'll say, okay, they'll work with management to say, okay, how much cash flow do we have? What was our dividend in the past? Can we increase it, or do we want to keep it the same? And they'll set a payment, a per share payment of dividends that they're going to have for this quarter. Then they'll set the ex-dividend date, and this is very important. This is probably the most important date for a dividend stock. The ex-dividend date is the first day that the dividend trades without, or the stock trades without the dividend. Okay, so if you're looking at a dividend stock, you want to buy that, you want to get that next dividend that comes out, then you have to own that stock at least the day before that ex-dividend date, right? Because the board of directors is going to say, okay, you know what, we're going to pay this dividend. We're going to pay it to everyone that owns the stock on this day. So that'll be the day before the ex-dividend date. That day after, the dividend's already paid out. Technically it's already paid out to all the investors that day before. And then they'll also set a payment date, which is usually about 2 weeks after that ex-dividend date. Just gives time for clearing and figure out who those investors actually were. And that's when the dividend actually hits your account and you see that money. So the ex-dividend date, very important to own the shares before that date if you want that dividend. Now, even if you buy the dividend on that date or buy the stock on that date or after, you're still going to get the dividend, in future payments, every 3 months when they declare another one.
Gotcha. So I know we're talking about dividend investing in part to generate as an additional income stream for folks. And I know you talked about, not issuing the dividends if you've already committed to it. It's tantamount to putting grandma out in the field. How reliant is it to get my dividend and to get a predictable dividend return, so I can expect quarter after quarter what my income is going to be to make sure I can cover my expenses?
Sure. Well, and like you talked about, there are a lot of investors that depend on those dividends for their paycheck, for their living expenses, especially retirees. So it is a sacrilege to cut those dividends. So a lot of companies, they will plan their cash needs out years in advance to be able to set that dividend. And so that it's very much very rare that somebody will cut a dividend. In fact, there are stocks that pride themselves on 50 plus years of increasing dividend payments. So every year they increase the dividend payment a little bit. Those are called the dividend kings. There's also the dividend aristocrats, which is 25 plus years of increasing dividend payments. So there are a lot of companies out there that pride themselves on that cash return and not just holding the dividend steady, but increasing it as well.
Yeah. So you talked about this ex-dividend date. I know I don't want to get too deep in the weeds here, but you mentioned it's a really important thing to keep in mind. And folks, the reason why I'm bringing this up is because I also was on the phones taking calls from individuals and would get these calls asking what's the ex-dividend date, or why did this stock price drop so much? And can we talk a little bit about how do dividends payouts affect a stock price, or how do dividends in general affect a stock price?
Sure. Well, it can get really technical. The theory is that a stock's price should fall by exactly the same amount as the dividend when that dividend gets paid out, right? Because if you think about it, as an investor, you own all the future earnings of that company. Well, if they return some of those earnings to investors as a dividend, then those earnings are no longer available for growth in the future, right? Mm-hmm. And so if that dividend has been taken out of its earnings, paid out to investors, then future investors they shouldn't be paying for that dividend that just got paid out. That's the theory. It really doesn't happen exactly like that. A lot of times, stocks will even go up, when their dividend is paid, just because investors have that reminder that it is a good dividend paying stock. So it doesn't really work in theory. I will tell you that just because it has lower earnings kept aside for growth, then dividend paying stocks tend to appreciate less than other companies, right? If you've got a company keeping all of its earnings, reinvesting that into future growth versus another one that's taking 50% of its earnings out and paying that out as a cash dividend to investors, it's naturally going to have less opportunities for growth. So that can tend to hold the share price down a little bit. Often dividend investors really don't care because they care more about that dividend and that cash payment. But there is a trade-off, especially with dividend stocks that pay a very high yield. If they're paying 60 or 70% of their earnings to investors as that dividend, and they're only holding back 20 or 30%, then obviously that is going to very much hold the growth and the potential for the stock price to rise back on that stock.
Sure. I would think a follow-up question then would be, why would a company choose one path over the other, reinvesting its earnings back into the business for growth or issuing dividends? What are the pros and cons of both? Do you know?
Sure. Well, the biggest reason is just for opportunities, right? Opportunities for growth. A lot of companies and in certain industries, utilities is a very good example. There's just limited opportunities for growth in the utilities field, right? It's a regulated industry. There's only so much electricity people are going to need, right? And so they don't have as many growth projects that they could invest in. So they're going to return a lot of that to investors. Energy stocks, oil stocks are another good example. They're looking out 10, 20 years and seeing very, very much lower oil demand, that shift in energy transformation. So they're going to be, instead of investing in these new oil fields that are going to cost billions of dollars and maybe not even pay out in the future, they're going to return that to investors now as a cash dividend. So it's really that trade-off between, okay, what are our opportunities for growth? Can we take some of that money instead and pay it out to investors? A lot of companies, again, though, just pride themselves on those dividends. There's a lot of dividend investors that are dyed-in-the-wool, dividend cheerleaders, and they will invest in a stock if it pays a high dividend. So a lot of companies just kind of target that as a strategy to draw investors.
Yeah, you mentioned this term high dividend. What does that mean? I mean, I think we're kind of going into this territory of what is a yield, dividend yield, right? When because it is funny, folks, sometimes when you look at these dividends and you think to yourself, this is a high dividend and it's paying 6.25 cents per share, and you're like, that doesn't seem like a high amount of money.
Sure.
So
How do
let's
you
talk
pay the
about
bills?
right.
Sure. Yeah. The dividend yield, it all comes down to that, right? It is the dividend yield is the dividend paid. So on an annual basis, it's always on an annual basis, very important. Dividend paid divided by the share price, right? So if a company pays, let's say, a $2 dividend, and it's $100 stock, then that is a 2% yield. Okay, it is paying. If you think about it as you invested $100 in the stock, you get $2 back each year. That is 2% return on your money, right? Now, of course, the dividend yield is going to change. It's going to change depending on where the stock price goes. If that $100 stock jumps up to 200 and they keep their dividend at $2, that's now a 1% yield. Okay, so it's so you're still getting that 2% or that $2 dividend, but since the stock price has changed, then that new return on your money on your $200 stock is now only 1%. A lot of math, probably only interesting to math nerds like myself, but very important, right? Like we said, most dividend stocks pay out 4 times a year. So that $2 dividend stock is going to pay out in 50-cent increments, right? So you're going to get 50 cents every 4 months, every 3 months, add up to $2 a year. Now it's very important.
Spend that all in one place.
Sure, yeah. Well, if you've got a lot of shares, then it can be some money, but it is a little misleading sometimes. Investors think they're not really earning much. Very important though to not just chase those higher dividend yields, right? Some stocks, paying out yields of 8, 10, 12%, and investors just flock to those before they realize that, okay, you know what, does this mean that the company is paying out so much return that it's not holding anything back for for growth. It's not not even holding back enough out to support the company, and is going to have to cut that dividend. So a lot of times, if a dividend is so high, it's above 8 or 9%, and it sounds too good to be true, it probably is. So which is why I kind of recommend dividend stocks. If you're really focused on dividends, staying within that 3 or 4% up to maybe 7% realm, that's going to be a reasonable return on dividend stocks, plus some kind of a stock price growth as well.
Yeah.
So what type of investors should start thinking about investing in dividend stocks?
Sure.
How do I know that I might be a candidate for this kind of a strategy?
Sure. Well, I think one, it's a good investment for any type of investor, right? Whether even if you're one of these meme stock investor that just wants to get rich on stocks over the next week, then it's always good to have a little bit of a diversification, right? We call it, or a little spread your risk out a little bit. So when your shares of AMC don't take off and shoot the moon, then you still have those dividends coming in.
Or SVB.
Why are you laughing, John? This is I mean, aren't we all ape millionaires by now? But no, it's just a good idea to have some dividend stocks to get that positive cash flow, that positive cash return, like we talked about, this guaranteed cash return. But they also tend to be, obviously, if you think about why that company is paying those dividends, because they have fewer growth opportunities, maybe they're a more mature business. They also tend to be the value stocks, the stocks in those safer sectors like consumer staples, like utilities. So it's just a good way to spread out your risk with some of the tech stocks and the internet stocks that we all love for that make me rich kind of idea. So that's important, obviously, for retirees or anybody approaching retirement and wants to just live off those dividends. Great way to do it. Like I said, those dividends are sacrosanct for companies and are very reliable, very dependable for the most part. And you can actually just live off your dividends.
Mm-hmm. Yeah. But a lot of people do reinvest their dividends back in to grow their share value or their ownership value.
Yeah, that is the most important thing to do. If you're not living off those dividends, if you don't need that income, then sure, reinvest it and make money off your money, right?
100%.
Definitely.
So
I just want to throw something in here since we talked about dividend payouts, and the difference between a dividend payout when it's in a tax deferred, tax free account or a taxable account. So
Definitely.
if it's in a retirement account of some sort, your dividend gets paid out, and because it's in that retirement account, you don't have to pay taxes on it. But
David, you're stealing my thunder. Man, one of the most important things. To
Let the professional talk.
Right.
But
no, it's you're saying it right there. It's so important to prioritize your dividend stocks into those retirement accounts, because you're going to save on the taxes, right? If you receive a dividend in a taxable account, a regular brokerage account, even if you reinvest that money, if you don't take it, even if you take it out, doesn't matter. If you receive a dividend each year, you're going to get a 1099 from your broker. They're going to show all the dividends that you received from a company, and you're going to have to pay taxes on those. Now, dividends are taxed at a little bit lower rate than income if you hold them for long enough. If you hold them for 60 days, then but you're still getting taxed, and you no longer have the ability to make money on that money, right? Whereas if you hold them in a retirement account, then you don't pay taxes until you take the money out. So you're going to keep that entire dividend there. You're going to reinvest it and grow tax free.
Yeah, so that's definitely an important point, because I remember talking with clients when I was a broker, and having to explain that idea of, well, I got paid a dividend, but I just reinvested it. Why am I having to pay taxes on this? I just put it right back into the company. But the government looks at it as the same. You either took the $500 and went off and bought Beyonce tickets, or you took the $500 and you went and bought more shares of Apple.
If you want to sit in nosebleed, David, it's more expensive. You won't be able to see her.
But the government looks at it. You got $500. We need our portion. Whether you decided to, they don't care what you decide to buy. They just want their portion of it, right? Even if it's going back.
Greatest
into that
takers
same
in
company.
history.
Yeah.
U.S. government.
Hey, Americans love to spend. Why do you think Uncle Sam would be any different?
I don't know.
Right,
No idea. Right.
exactly. Tired of all the credit card offers you get from your current credit scoring app? Download CreditWise by Capital One today to avoid them.
So I don't, if I'm investing in dividend stocks, I don't know it. But so I had to do my research for this episode. I did see from what I did read that it looks like dividend yields are declining. Is that true? And if so, does that still make dividend investing a viable strategy?
Well, I think if dividend yields have been declining, it's only a matter of because stock prices have been going up, right? And those payments that the board of directors is deciding on haven't kept up with those stock prices, right? If stock prices, again, if that $100 stock goes up to $200, but that $2 dividend stays the same, then yeah, you're getting a lower yield on that. Over the last year, though, I'd say dividends yields have actually been increasing, just because stock prices have been coming down. And again, even when the stock price comes down, the board of directors, that company is loath to cut that dividend. So they will, a lot of companies, even if when they get into trouble, cash flow trouble, they will borrow debt or cut spending in other areas before they cut that dividend.
Or do a reorg.
Yes. Or do a reorg,
yeah. I guess it is a kind of an interesting idea here. You talk about the fact that the increase in a stock's price, unless they increase the dividend as well, the dividend yield will drop. So to make that company's dividend and the company itself attractive as it's increasing in price, that may be one of the reasons why you have these dividend aristocrats or dividend kings, because they have had consistently, their stock price has consistently grown over the decades, and they want to just match that or keep that dividend at something that's attractive to people.
Sure. They know that, for many dividend investors, it is very important to get a certain yield on their stock. So they tend to try to keep it up, with the stock price, which of course can run into trouble if they go a little bit overboard on that. If that stock price doubles again, and they're trying to keep that same dividend, can they double their dividend payment to $4 and still in the future be able to meet that dividend payment? So what we've seen in a lot of energy stocks, a lot of energy companies over the last year, that in 2022, when oil prices went through the roof, right, on the invasion of Ukraine, went to $120 a barrel, then a lot of oil companies, they just doubled or tripled even their dividend, and now they're seeing, as oil prices come down, they're seeing we might not have the cash flow to pay those dividends. So it can be trouble for a company. You always want to look for the history of dividends, history of dividend cuts and growth. In something like Yahoo Finance, you find it very easily with the historical data tab. You can see all the dividend payments they've paid out, and whether they've grown or whether they've been cut. And look for those companies that have grown or that have increased their dividends for decades.
Absolutely. So it's as with most investing concepts or strategies, there is the simple way to do it, and then there's the super complicated way to do it, right? And so what are some simple ways to do it? Do I have to sit there and study stocks? Okay, so there's thousands of stocks and hundreds of them are paying dividends, and do I have to figure out which ones are the aristocrats, and is there an easier way? Should I focus on one? What should I do?
Sure. Well, I think it gets to the heart of investing, right? That I always recommend having at least 50 or 60% of your money just in ETFs, right? Exchange traded funds. Those are the funds that hold hundreds or even thousands of stocks, holding a lot of those, the majority of your money, actually. And so your risk is just spread out across so many companies. You really don't have to worry about any kind of damage to one company or not. It's not going to hurt your portfolio. It's a great way to get into these themes like dividend investing. And then, with the remaining 30 or 40% of your money, you can pick individual stocks if you want. I don't want anybody to feel, pressured or like they have to invest in individual stocks, because it's really just not necessary. So within that, in the ETF portion, there's some great ETFs for dividend investors. There is the Dividend Aristocrats Fund, which again holds those companies that are part of the S&P 500. So they're already one of the 500 largest companies in the United States, but they've also been increasing their dividends for 25 plus years, right? So a great history of commitment to that dividend. That is the Dividend Aristocrats Fund, that's ticker NOBL. Doesn't pay a very high dividend yield, but obviously it's consistent and it consistently grows. Another one I like is the Schwab Equity Income ETF. That's ticker SCHD. Pays a little bit higher dividend yield than the NOBL. Doesn't have that history of dividend growers, but most of the companies in there, they're very, very large companies. They've increased their dividend consecutively over decades, and it's a very safe fund as well. Within those individual stocks, you just go with the companies you love and the ones that maybe just happen to pay a dividend, right? It's more about which companies you think have a real competitive advantage in their industry and are growing their revenue, growing their earnings, because of course that's going to be eventually, as they grow those earnings, that's going to be more and more dividends.
Sure. You touched on this a bit. Which industries tend to have bigger payouts than others?
Sure. Well, again, it's going to be those with maybe a little bit less growth. It's going to be those that are more mature companies, value companies. So it's going to be companies like utilities in the utility sector. It's going to be consumer staples, those food packaging, processing, and food companies. Going to be things like that. Going to be energy companies, all pay very high dividends as well. The ones you won't necessarily find a lot of dividend stocks in, though you will find some, are going to be like technology, communication services is a little bit different because it's telecom and internet stocks. So telecom stocks like AT&T, Verizon, some great dividend payers, while the internet stocks in that sector, not so much.
Yeah.
Telecom, energy stocks, consumer staples stocks, and utility stocks.
How do you find that ESG stocks do with distributing dividends? Are they less or more so?
I really haven't seen a lot of data on that. I think if they're really committed to that idea of governance, then they should be committed to some kind of a shareholder cash return as well.
Yeah, we think.
If they're the social aspects, it's really hard because it really depends on how they're defining that environmental, social, and governance. Whether they hold that cash return as part of that as important.
Gotcha.
Yeah. You'll probably see that an ESG portfolio or ETF has some dividend paying stocks in it, but not all of them are probably that way, because I guess, to a certain degree, it seems like more companies that are a little bit newer companies seem to be on the pushing for or aligning themselves with ESG, which means they're probably still in that growth mode. Whereas you have some of these consumer staples that you mentioned, like Unilever, I think is a company that's been around for over 100 years. AT&T has been around for over 100 years. These are companies that have been around for a long time, and they probably don't have as much of an alignment. Their board doesn't have as much alignment as maybe a younger or fresher company.
Probably.
Sure, that makes sense. Yeah.
So how would I use dividends to prepare me for retirement? And then once I'm in retirement, what's an optimal way to use dividends?
Okay. So to prepare for retirement, again, so important to reinvest those dividends. One thing in your retirement planning is you can actually figure out, okay, how much do I need to invest in dividend stocks, a fund or individual stocks, to really pay those bills that I'm expecting. You can calculate that basically just using the yield and your expected expenses. Right. So if you have $1,000 spending a month that you want covered with dividends, then you take $1,000 divided by we'll use our 2% again, and that would be so that would be what, 500,000.
Yeah. Yeah. The two math nerds are nerding out on number crunching. I'm going to think about a Beyonce song right now.
Okay. Let's start that one over so I can actually sound like I understand the math in my head instead of having to open up the calculator.
It was fun. So I'll ask it again though. So how can I use dividends to prepare me for retirement? And then how can I use dividends when I'm in retirement optimally?
Sure, great question, and it is so important for a lot of retirees or near retirees to be able to plan this out. And you can actually plan out, how much you need to invest in a dividend stock or dividend fund to pay those expenses, right? So for retirement planning, if you're let's say if you're going to have $1,000 in expenses each month that you want to pay with your dividend stocks, and you're getting a 2% yield, then you just take the amount you need, $1,000, divided by that 2%. Now, remember that that percentage, that annual yield is, well, it's on an annual basis, right? So you'd have to take the $1,000 times 12, so monthly $1,000 times 12 is $12,000, and then divide by that yield, which comes out to $600,000 you would need in those stocks to get that $1,000 yield. It's a bit of a disappointment sometimes for investors how much you need in dividend stocks with those lower yields to make those payments. But it's something you're saving up and you're investing for your entire life. So
and it's we're talking about multiple streams of income. So this would just be one stream, right? Obviously, hopefully you have a decent Social Security, as well as you have other retirement assets that you're going to be able to withdraw from to help cover your expenses, and maybe a side business, real estate income, whatever. And this could be just one way to augment your overall strategy.
Sure. But yeah, it's and you can get higher yields. 4% is a very safe and reliable yield for a lot of companies. That obviously halves the amount you would need to invest for just $300,000 invested in a 4% yield, you'd be making $1,000 a month every month. And again, they're so reliable that you can set your bills by them, really. So that part of the planning is very important. Within the retirement phase, then I would say that. Don't be afraid to spend down your money. I know a lot of investors, they say, well, I just want to live off my dividends. I never want to spend, or sell stocks or spend any of that money. Well, it's half a dozen of one or six of the other, right? You're either taking money out of those dividends instead of reinvesting them, or you're selling some of that stock to pay for expenses. So, have a nice balance between selling some stock and taking some of that as dividends.
Well, so that brings me to another question. How would this affect the 4% strategy? Would this be part of the 4%, or is this in addition to, and I can reduce my 4% down to 3%, or how would that work out?
It's part of the 4%. It really goes into, okay, how much is your because again, we talked about in theory then that your portfolio amount or that stock price should adjust lower when that dividend is paid. That's really the theory behind it. And a lot of times we'll see that while the stock price won't go down the entire amount of the dividend, it will come down a little bit sometimes. So so if you're taking those dividends, you are taking a percentage out of your entire portfolio or of that stock investing, rather than just letting it compound and letting it grow. So that is a part of the 4%. If you've got a 4% yield across your entire portfolio and you take all those dividends out each year, then that's basically your 4%.
Gotcha.
Yeah. And I do know individuals who are working towards that strategy of having a stock portfolio that allows them to pay out a roughly 4% or enough money to cover their monthly expenses, and then they have other sources of income, Social Security or things like that. Maybe they still have a side hustle or a side business, or they have a business that is still paying them. As you mentioned, John, it was the multiple streams of income is really I think that's the conversation more and more people are having about retirement now, instead of just having this massive stock portfolio that always can always withdraw 4% from.
Yeah, because it's not really the reality for so many people, right? For so many of us, it's having just all your investments are going to be able to pay for everything you want to do in retirement. Is for fewer and fewer people, I think, out there. What is it? And I can't remember what's the limit on actual income before it actually detracts from your Social Security. I think you can make up to like $1,700 a month before it lessens how much you make on Social Security, something like that. So yes, side income, passive income, always.
Yeah, absolutely.
Oh yeah, that's right. If you have a job or you have some sort of other forms of income, real estate income, things like that, it eventually will detract from your real estate payout. I thought you were talking about your payouts from your dividends detracting from your real.
No.
And I was like, wait a second.
No. You can take capital gains. You can take dividend payments without it being counted as income, right? Because when you sell a stock, you pay capital gains taxes. When you receive a dividend, you pay, dividend taxes or taxes on that. But as long as you hold it, more than 60 days, hold that stock for more than 60 days around the dividend payment, and for most people, they're holding those dividend stocks for years, then it's taxed differently than income. It's not added to your income. So it's not necessarily counted as income in retirement. So you can get capital gains, you can get dividends in retirement, and they won't take away from your Social Security the amount you receive. It's only if you're making an income from from a side hustle or from some other thing that is actually counted as income.
Right. Don't take my Social Security.
Which you did bring up a good point, that this is the most likely the reality for the vast majority of us. We just saw a video on YouTube the other day that mentioned that individuals who are 55 and over have an average not average, I think it was the median retirement balance was roughly $270,000. And so these are individuals who are at or really close to retirement age, and they don't have a whole lot saved. And it's a huge percentage. It's something, I know it was above 25%.
I know what you're
have
talking about.
Zero saved.
Oh, yeah.
But it was shocking. It was shocking.
Yeah.
Oh, yeah. My mom had zero when she started taking disability. But yeah, even that 270,000 on, the 4% rule, right, is only about 11,000 a year. So that is less than $1,000 a month that you can, safely take out. Of course, whether you can safely take it out or whether you need it to live is the reality I think a lot of people are facing, and they're having to take out 5 or 6% a year.
Yeah, this is why we keep talking about ways to earn more money and save and invest more.
Exactly. Yes, that's why investing is a part of our theme, one of our themes, and financial independence is another one of our themes. So
absolutely. So you seem to like what you're talking about. If any of our listeners or watchers wanted to get more of Joseph Hogue, how would they do such a thing?
Get as much Joseph Hogue as you can.
Is that possible?
There's a lot of me to go around. As I get older, there's more and more of me to go around. Sorry. Yeah. But which reminds me, I got to go running today. I really got to go today. But no, I love for people to stop by the YouTube channel. It's called Let's Talk Money. Love for people to join the community there. It's the Bowtie Nation, even though I'm kind of not wearing the bow tie today, just kind of relaxing, and just ask me anything. I'm always willing to share what I've learned. I actually more than 20 years in the business. In the investment industry, I've worked venture capital, worked with private wealth management and equity analysis over about 20 years, and just love talking about investing and making your money work for you.
Yeah, just for context for our audiences, they know that we've been in different masterminds over the years, and we were in a mastermind for a couple of years with Joseph, and we were in when you decided, hey, I'm going to focus on YouTube and I'm going to double down on it, and it was amazing to see you grow from pretty much nothing to just like skyrocketing. And how many followers do you have now on YouTube? I can't even keep up anymore.
It surprises me every day. I'm just over almost 600,000, actually, about 594,000. Late to the game as usual, but started in 2017. And
you focused and you figured it out.
Yeah. Well, I think it's important that sense of community that you get from video face to face, and it's a great feeling to be able to reach out, not just in written words on a blog, but face to face with YouTube, and it's been great.
Yeah, so definitely for our listeners, if you have any more questions about investing of any kind, definitely check out Joseph's channel. It's definitely worth the time. So thank you so much.
He does talk about meme stocks every once in a while, though.
Every once in a while, we all have to. You feel the urge.
Everybody's got to do that SEO, David. Don't criticize. Thank you so much.
Hey, what is it? Hate the game, don't hate the player.
Yes. Yeah, we try to do that. We're not so good all the time. Start your journey to financial independence with a checking and savings account that doesn't nickel and dime you with fees. Get a Capital One 360 checking or 360 performance savings account at Capital One today.
Thank you, Joseph, for a fun and informative interview. Thank you, our listeners and watchers, for joining us for another episode. Here's your Quick Money takeaway from this episode. If dividend investing interests you and you want to build a portfolio of dividend stocks, do your homework. crunch the numbers that Joseph mentioned in this particular episode.
Then join us this Thursday for our new bonus series on the most affordable, most LGBTQ plus friendly city in each state. All 50, regardless of whether you like them or not. This week, we're talking about Texas. Have a great week.